So, the market is on fire right now, riding this huge wave of AI optimism. But, it's got everyone asking that one nervous question. Are we just blowing another bubble here? Today, we're going to dive into Standard Chartered's 2026 outlook and see if they think this whole party is about to come to a screeching halt. I mean, right now, the energy in the market is just electric, and the engine driving all of this excitement is, of course, artificial intelligence. You can feel it, right? It's like we're on the edge of this massive technological shift, and stock prices are absolutely reflecting that excitement. But this kind of rocket ship rise, it always brings that familiar nagging sense of, uh-oh. And that, of course, brings us to the big one. The question on everyone's mind. Is this incredible AI-fueled rally just one giant bubble that's getting ready to pop? It's the million, or heck, maybe the trillion-dollar question that Standard Chartered's new report tackles head-on. So what's the verdict? Well, according to them, not yet. The report is pretty clear that while everyone is talking about a bubble, they believe there's still a ways to go before we're in real, true bubble territory. All right, so let's dig into why they're saying that. The first thing everyone jumps to is the dot-com bubble back in the late 90s. But the report points out a couple of crucial differences. First, the amount of money being invested today, when you look at it compared to the size of the whole economy, is actually way lower than it was back then. And number two, and this is really the key, the companies leading the AI charge today are insanely profitable, unlike a lot of those dot-com darlings that were basically running on hype and fumes. Okay, so if we're not in a bubble yet, how are we supposed to play this? What's the strategy? Well, the report breaks it all down into three key themes, and the first one is all about equities. How to ride this massive AI wave without completely wiping out. And look, this optimism isn't just fluff, it's actually backed by some pretty staggering earnings growth projections. The report is forecasting that in 2026, corporate earnings in Asia, excluding Japan, could jump by almost 19%, with the US not far behind at a very strong 14%. The idea is that this AI boom is going to translate into real, hard cash flow. And believe me, this isn't just a flash in the pan. The commitment here is enormous. The major hyperscalers, we're talking about the absolute giants of cloud computing, like Amazon, Google, Microsoft, they're projected to spend a staggering $500 billion on AI stuff in 2026 alone. This isn't a short-term gamble. This is a fundamental rewiring of our tech infrastructure. Yeah, and that $500 billion, it's not just disappearing into the cloud or into lines of code. It's buying steel, concrete, and copper. I mean, we're talking about a massive real-world build-out of physical stuff. Brand new data centers, sophisticated cooling systems, and huge upgrades to the power grid just to handle all the electricity this is going to need. That sends ripples through a lot of old-school industry. So here's the real puzzle for investors, right? The growth is undeniable, and you want a piece of that action. But the prices, the valuations, they're already pretty high, which means the market could get spooked by any little piece of bad news. So the question is, how do you stay in the game without getting burned? Well, the report's big answer is all about smart diversification. Basically, don't just go all in on US tech. They suggest you balance that high-octane growth with exposure to Asia, specifically China and India, where you can find growth at maybe more reasonable prices. And then, crucially, you pair all that with some defensive sectors, like US healthcare and utilities, which give you stability and, as we just saw, are also catching some of that AI infrastructure wave. Okay, let's switch gears to the second big theme, and you'll see how this all connects. After talking about high-growth stocks, the report looks at the other side of the portfolio, how to generate stable income. And this is where they see a really interesting opportunity starting to bubble up. Their message here is super clear. If you're hunting for income, they argue that the best place to be right now is in emerging market bonds. They actually expect them to outperform bonds for more developed countries. And if you want the one number that really tells the story, here it is. Emerging market government bonds in their own local currencies are offering an average yield of about 6.6%. Now, in a world where we expect central banks in the US and Europe to start cutting rates, that kind of yield looks incredibly attractive. But listen, it's not just about that high yield. The report actually builds a really solid case for why this makes sense. A lot of these emerging countries have gotten their financial houses in order so their debt is safer. The extra yield you get is significant. And investing in their local currency bonds is a great way to get some diversification away from the US dollar, especially since the report thinks the dollar is likely to get a bit weak. All right, so we've got our growth engine with stocks, our income stream from these EM bonds. What's missing? the safety net. That third and final piece of the strategy is all about the diversifiers that can protect your portfolio when things inevitably get bumpy. I love the phrase the report uses for this section, chasing glitter. And of course, the most famous glittering asset of them all is gold. They see it playing a really important role in a balanced portfolio heading into 2026. So why gold right now? Well, it boils down to three main drivers. First, central banks all over the world are buying up gold to move some of their reserves away from the US dollar. Second, as interest rates are expected to fall, what we call real yields, that's your return after inflation, are also likely to drop, which makes an asset like gold, which pays no yield, look a lot more attractive. And finally, just like we said with EM bonds, a weaker dollar is usually good news for the price of gold. Okay, but no outlook is complete without talking about what could go wrong, right? It's not all sunshine and roses. The report is definitely optimistic, but it's also very clear-eyed about the potential storms on the horizon. Let's take a look at what they're worried about. They're flagging four main things to keep an eye on. Number one, some kind of negative shock to the AI story. What if the profits don't live up to the sky-high hype? Two, a credit event. Some big company goes bust and it sends a shockwave of fear through the system. Three, the Fed does an about-face. Maybe inflation is stickier than they thought and they can't cut rates. And finally, a real wild card. The Bank of Japan suddenly gets aggressive, which could suck a lot of cash out of the global system. So, with all that on the table, the opportunities, the risks, what's the takeaway? What do you actually do? Well, the global CIO, Steve Bryce, lays out two simple paths. If you're already invested, it's time to stress test your portfolio. See how it would have held up in a crash like 2000 or 2008. If those numbers make your stomach churn, it might be time to diversify. And if you're just starting out, the biggest mistake is sitting on the sidelines. Just stay disciplined, figure out your target, and keep investing consistently. And really, it all comes down to this one final piece of timeless wisdom. After you look at all the charts and analyze all the data, success in investing so often boils down to this. The market is going to be a roller coaster. Managing your own fear and greed is the name of the game. So there you have it. The outlook for 2026 feels like, well, cautious optimism. The AI wave is real, it's powerful, but the water is definitely getting a little choppy. The report lays out a potential map, a way to balance growth, income, and safety. But at the end of the day, the real question is, how are you going to navigate it?